Hi folks, and welcome to lecture module 12.2, where we're going to talk about the direct method of completing the operating activities section of our statement of cash flows. So again, there's typically two ways to attack the operating activities section. In this course, we're only going to deal with what regulators prefer, which is our direct method. But first, let's take a step back and just review why we complete a cash flow statement in the first place. So again, cash flow is a fairly significant element that we're going to work with inside of a company because, again, cash is sort of king. If we don't have cash to meet our short-term liabilities, we don't have cash to pay our employees or our suppliers, there's not much else that we can do. I always share a story of a very well-known organization that had some fantastic, innovative, high-tech product that was very capital intensive, so it had a very big sort of ticket price. And the company, did great generating sales. They had all kinds of great contracts lined up, but they had a very long sort of processing. So it took them a good year and a half to actually manufacture and deliver on this customized product. And so, the team overall was really looking at how do we continue to generate these sales. But no one was looking at the cash flows. So we knew that revenues were coming in down the road, but no one was really watching the bank account and how much was there. And they showed up at their manufacturing facility one day, and the doors were locked. They had bounced about three months of rent, and their landlord locked them out. So again, lots of revenue to come down the road, but they were in a shortfall of cash for a good period of time, and that cost them a lot of their contracts in the long run. So keeping an eye on cash is pretty important. We need to know when cash comes in, when it's available, and when we can use it, and when cash is required to go out, so we can make sure that we have enough on hand. This also helps us to sort of understand if we need to go out and borrow some money. So maybe we need to invest, borrow from the bank, or maybe we need to get some additional investors to generate some cash into the organization. So as we keep an eye on cash, typically this is a statement, especially for new startups, that we put a lot of time and effort into. We want to understand for the first year to 2 years, where does the cash come in and when does it go out? Because if we have a couple of months of negative cash flows, we're going to need to borrow, and as a new startup, that's not always easy. So let's dig into, again, our statement of cash flows deals in three different areas, and the three major activities are operating activity, investing, and financing activities. So the operating activities are sort of the day-to-day things, as we talked about at the beginning of the course. Transactions that either create revenues or expenses that go into profit. Typically, our operating activities also include some non-cash elements, so accounts receivable, accounts payable, depreciation expense. All of those things aren't involved in cash right away, only when we collect them down the road. And so what we need to remember is that as we're going through our cash flow statement, we always have to ask ourselves the question, does this activity affect cash? Is cash coming in or going out? So for example, if we issue debt to purchase assets, no cash was involved there. If we issue shares to purchase assets, again, no cash was involved. If we have an exchange of properties, so one property for another, again, no cash involved. Depreciation expense, no cash involved. So all of those things we need to be aware of. There's a lot of activities that don't actually create cash. They're all just internal record-keeping pieces. So look at the format of our cash flow statement, and we're going to work through this again as we continue this module. But we start off with our operating activities. So we complete using the direct or indirect methods. In our case, we're going to primarily deal with the direct method. And then our investing activities and our financing activities to figure out our net increase or decrease in cash. And then we'll cross-check that by taking the balance of cash at the beginning of the period, and we should end up with our cash balance at the end of the period. So this is just a way for us, again, to verify that we're correct. So our beginning cash plus the increase in cash, or minus the decrease in cash throughout the year, should produce our ending balance in our cash account. So we start off with our operating activities, so let's take a look here. We can use the direct or indirect methods for operating activities, and again, they get the same amount, but it's just a matter of how we get there. So our indirect method starts with our profit and adds or subtracts any non-cash items and adds any items that haven't been factored in that affect cash in our operating activities. And primarily internally, many companies use that. But again, our standard setters prefer the direct method, and our direct method breaks it down into activities that were utilized in our day-to-day operations, and we adjust them based on whether we've accrued cash or not. Okay, and let's walk through what that actually looks like. So we adjust our income statement from an accrual basis to arrive to our net cash in or out. And so we're going to take a look at what that looks like. We're going to start off with cash receipts from customers. So our direct method in operating activities has a number of sections. We start off with our cash receipt from customers. So we're going to take all of our revenue that we've generated inside of our given year, and we're going to assume that it's all cash up front. So we'll take our entire revenue amount, and then we're going to adjust for what wasn't actually received. So if we had a decrease in accounts receivable, that means that not only did we generate all of our revenue in cash, but people who owed us money gave us the money, so we have more cash on hand. Whereas if our accounts receivable has increased, that means that we now have more money coming to us, but we didn't actually receive the cash. And again, we're only dealing with cash transactions here. So for example, if in 2014 our accounts receivable balance was $5,000, and in 2015 our accounts receivable balance was now $8,000. We have money that hasn't been paid to us. We have an increase in accounts receivable, and so we would take our revenue total and subtract the increase in accounts receivable, so subtract the $3,000 increase. As opposed to if we had a circumstance where our accounts receivable went down, now not only did we generate our revenue, but we also collected cash from customers who owed us money from previous years. So we got our revenue in cash, and we also received cash from amounts that were due to us in the prior years. So we add the $3,000 in the second circumstance. The next thing we look at is cash payments to suppliers. So this is anything that we've actually paid out for operating activities. So our cost of goods sold is where we start with. And we're going to add an increase in inventory or subtract a decrease in inventory. Again, because what we're looking at here is our cost of goods sold was the cash that we've had to pay out. If we bought additional inventory, we also had to pay cash out to have that on hand. Whereas if we had a decrease in inventory, our cost of goods sold, we actually sold things that we've already accounted for in cash payments from previous periods. And so we'll take our cost of goods sold and subtract any decrease in inventory values. And then the other element we need to look at is our accounts payable. So when we bought this inventory, did we pay for it on account, which means that we didn't have to pay out the cash? Or have we repaid amounts that we owed from previous periods? So has our accounts payable declined? And so for example here, if our cost of goods sold was $50,000, our inventory in 2014 was $10,000, and in 2015 was $15,000. Our accounts payable in 2014 was $5,000, and our accounts payable in 2015 was $2,000. Let's take a look at what our cash payments to customers would be. So again, we take our cost of goods sold of $50,000. We have an increase in inventory of $5,000. And so we're going to add that $5,000 to our cost of goods sold. So not only did we sell everything we had on hand, but we actually added more to our inventory. So we outlaid another $5,000 for inventory. And our accounts payable went down by $3,000. And so not only did we pay for the cost of goods sold, and we paid for the inventory that's grown, so those are cash payments out, we've also paid out an additional $3,000 to our accounts payable from previous periods. So our cash payments to suppliers would then equal $58,000. So again, this mathematical equation, you can sort of try to memorize these things or conceptually think, have I paid more cash out or less cash out as we go forward? The next is cash payments for operating expenses. And very, very similarly, we're going to take all of our operating expenses. We'll add any increases in prepaid expenses. So have we outlaid more cash to prepay expenses later? Or have we utilized some of the things that we've already paid for in the past? So we've had a decrease in prepaid expenses. And then do we have any increase or decrease in accrued payables, expense payables? So do we have a salaries expense that we owe our employees, in which case we haven't paid it out in cash? So let's take a look. If we have operating expenses of $120,000, in 2014 we had prepaid insurance $5,000 and prepaid rent of $10,000. In 2015 we had prepaid insurance of $6,000 and prepaid rent of $5,000. In 2014 we had salary payable $1,000. And in 2015 we had salaries payable of $1,500. So let's take a look. We take our operating expenses of $120,000. If we look here, we have an increase in prepaid insurance and a decrease in prepaid rents. So we're going to add any increases in prepaids. So we're going to add the increase of $1,000 in prepaid rents and subtract the $5,000 of prepaid rent. So prepaid insurance, not only did we use the insurance that we had prepaid, but we also added more money to it. So we put additional funds out to it. So our prepaid insurance has grown. Whereas our prepaid rent, we've utilized some of our prepaid rent, which means that we didn't actually pay the cash out for our rent expense. We've utilized some of the prepaid, so cash didn't go out for that amount. So we need to adjust our operating expenses by that amount. And we also have an increase in a payable. So we've recognized salary expense inside of our operating expenses, but we've increased our salary payable. So $500 of that payable actually hasn't been paid out in cash. So $500 of the salary expense is not been paid out in cash. And so if we look here, we now have $16,500, give or take, maybe $15,500. Sorry, $115,500 as our cash paid out for operating expenses. Okay, the next thing we look at is our cash payments to employees. So again, our salaries expense plus or minus any increase in salaries payable. So we saw that in the last example there. And cash payments for interest. So again, our interest expense plus any decreases in interest payable, which means that not only did we cover our interest expense in cash this year, but we paid cash out to interest that we owed. Or the other extreme, if we've increased our interest payable, it means that out of the interest expense that we've recognized for this year, Not all of it was paid in cash. Some of it is still owing, and so we haven't paid the increase in interest payable out. So we should remove that from our cash payments. And then we have our cash payments for income tax. And the same thing. Our income tax expense, add any decreases in income tax payable, and subtract any increases in income tax payable. So if you think of it as sort of a summary of these different transactions, when we're looking at our current assets, in our cash receipts, our revenues, we're going to deduct any increase in accounts and decrease any account balances. We'll add them to our cash receipts. In current liabilities, if we have an increase in that account balance, we're going to add it to our cash receipts and deduct it from our cash receipts if there's a decrease, and opposite in our expenses. All right. So if we look at how this actually looks, we have our operating activities. We'll start with our cash receipts from customers. So that's our positive cash inflow, our revenue, minus the account receivable difference, or adding the account receivable differential. And then we have our cash payments to suppliers for operating expenses, for interest, and for income tax. We'll subtract all of those from our cash receipts. So that's the operating section of our statement of cash flows utilizing the direct method. I recommend that you take a look at this and read through it in the chapter materials as well. It's important that you sort of conceptualize what this actually is doing and how we're keeping track of cash going in or out. This is typically a subject that students have some struggles and difficulties with. So take your time, work through some of the self-assessment problems that are provided, read through the materials in the textbook, perhaps watch this lecture another time just to sort of understand where they're going, and of course tune into our weekly tutorial where we'll do a couple more exercises and examples of our direct method. Thanks so much, folks, and happy studying.